I've been doing this for 70 years now. And if there's one thing I've learned, it's that knowing what not to buy is just as important as knowing what to buy. Maybe more important. I was looking at my portfolio the other day, the real one, not Berkshire's public holdings, and I realized something. There are entire sectors of the economy where I don't own a single share, not one. And that's not an accident. Let me tell you what I'm seeing right now. We're sitting here at the end of 2025, and the market's been on quite a run. The S&P is up. People are feeling wealthy. And everybody's got a story about their neighbor who made a fortune in this stock or that sector. I hear it all the time. But here's what bothers me. When I look at where money is flowing, I see the same patterns I've seen before. Not exactly the same, but similar enough to make me nervous, very nervous. There are 5 sectors right now where I wouldn't invest a single dollar of my own money. Not at these prices, not with these fundamentals, not with what I know about how businesses actually create value over time. And I'm going to tell you about all 5 of them. Not because I'm trying to crash the market or make headlines. I don't need the attention at my age, but because I've seen what happens when smart people, good people, pour their savings into businesses they don't understand at prices that don't make sense. I saw it in the late 90s with internet stocks. I saw it in 2006 and 2007 with housing. I saw it with gold in the early 80s. And I'm seeing warning signs now in these 5 sectors that make me want to hold on to my cash and wait. Now, before I tell you which sectors I'm avoiding, let me be clear about something. I'm not saying these are bad businesses. I'm not saying the people running them are incompetent. And I'm certainly not saying they're going to zero tomorrow. What I am saying is this. At current valuations, with current fundamentals in the current economic environment, I cannot find a way to make these investments make sense. Not for me, not for Berkshire, not for anyone who's thinking about the next 10 or 20 years instead of the next 10 or 20 days. You see, investing isn't complicated. It really isn't. You find a business you understand. You figure out what it's worth. You buy it for less than that. Then you wait. Sometimes you wait a long time. But what I'm seeing in these 5 sectors is the opposite of that. I'm seeing businesses people don't really understand, trading at prices nobody can really justify, bought by investors who are hoping, not calculating, but hoping that someone else will pay even more tomorrow. That's not investing, that's speculation. And speculation works great until it doesn't. Let me ask you something. When you buy a stock, do you think about owning that business forever? Do you ask yourself what that company will look like in 2026? 2030, 2035, or are you just looking at a chart and hoping the line goes up? Because here's the thing about these 5 sectors I'm going to describe. In every single one of them, the math stops working when you think long term. The stories fall apart. The justifications crumble. And that tells me something important. It tells me we're not in a market where people are buying assets. We're in a market where people are buying lottery tickets. Well, I don't buy lottery tickets. Never have. Never will. So let me walk you through this. I'm going to explain each sector, why people are excited about it, and why I'm staying far away. I'm going to give you numbers, real numbers, not just feelings. And I'm going to tell you what I think happens next. You might not like what I have to say. You might own stocks in some of these sectors. You might think I'm wrong or out of touch or too old to understand the new economy. That's fine. I've been called worse. But before you dismiss this, do me a favor. Listen to the whole thing. Think about the arguments. Ask yourself if the math really makes sense, because your financial future might depend on it. Here's what I want you to understand right from the start. Every single one of these sectors has a compelling story. Smart people believe in them. Talented analysts write research reports recommending them. Major institutions own positions in them. But compelling stories and good investments are not the same thing. Not even close. I remember sitting in my office in Omaha back in 1999, and everyone was telling me I didn't understand the internet. They said I was missing the biggest opportunity of my lifetime. They said the old rules didn't apply anymore. You know what happened next. Now, I'm not saying history repeats exactly. It doesn't. But human nature never changes. Greed, fear, the desire to get rich quick, the tendency to believe what we want to believe. These are constants. And when I look at these 5 sectors, I see human nature running wild. I see greed masquerading as analysis. I see hope dressed up as due diligence. I see people who should know better convincing themselves that this time is different. It never is. Let me start with the first sector. And this one's going to surprise some people because it's been one of the hottest areas of the market. I'm talking about cryptocurrency and blockchain technology companies. Now, hold on. Before you stop listening, hear me out. I'm not talking about whether blockchain is interesting technology. It might be. I'm not talking about whether smart people are working in this space. They are. I'm talking about whether you should invest in it. And my answer is no. Here's why. When I evaluate an investment, I start with a simple question. What does this asset produce? If I own a farm, it produces corn or soybeans. If I own an apartment building, it produces rent. If I own Coca-Cola stock, that company produces beverages and profits and dividends. But what does cryptocurrency produce? What does it create? What value does it generate that didn't exist before? The answer is nothing. It produces nothing. It creates nothing. It generates no cash flow, no dividends, no earnings. Its only value is what someone else will pay for it tomorrow. That's not an investment. That's a speculation on psychology. Now, the cryptocurrency enthusiasts will tell you I'm missing the point. They'll say it's a store of value, like gold. They'll say it's the future of money. They'll say the traditional financial system is broken and this is the solution. Maybe. But none of that tells me what it's worth. None of that gives me a way to calculate intrinsic value. And without that, I'm just guessing. Look at what's happened in this space. Recent market data shows the total cryptocurrency market capitalization has swung from hundreds of billions to over $2 trillion and back again multiple times. Individual cryptocurrencies have gone from pennies to tens of thousands of dollars and then crashed by 80 or 90%. Does that sound like a stable store of value to you? Here's what really concerns me about this sector. The people buying cryptocurrencies today aren't asking what they're worth. They're asking what they'll be worth. That's the greater fool theory in action. You're not making money from the asset itself. You're making money from finding someone willing to pay more than you did. That works wonderfully in a bull market. Everyone feels like a genius. But when the music stops, and it always stops, there's no underlying cash flow to fall back on. There's no dividend to collect while you wait for prices to recover. There's just nothing. I saw the same pattern with gold in the late 70s and early 80s. Gold went from $35 an ounce to over $800. People were convinced the dollar was finished, that inflation would destroy everything, that gold was the only safe haven. And you know what? Gold did exactly what I expected it to do. It sat there. It didn't produce anything. It didn't earn anything. It just sat there while the people who bought at $800 watched their investment lose 80% of its value over the next 2 decades. If you'd bought the S&P 500 instead, you'd have made 40 times your money in that same period. 40 times, because you'd have owned businesses that actually produced things and earned profits and grew over time. That's what productive assets do. They compound value. Non-productive assets, they just sit there hoping someone else will want them more than you do. Now, some of you are thinking, but Warren, cryptocurrency companies are building technology. They're creating platforms. They're revolutionizing finance. Are they? Let's look at that. The companies in this space fall into a few categories. You've got the exchanges, the mining operations, the blockchain infrastructure firms, and the companies trying to build products on top of blockchain technology. The exchanges make money from trading volume. That's it. When the market's hot and everyone's trading, they print money. When interest cools off, their revenue collapses. That's not the kind of stable, predictable business I want to own. The mining operations, they're in a constant arms race of computational power, burning through electricity at an astonishing rate to solve mathematical problems. Recent industry analysis shows some of these operations use more electricity than small countries. And for what? To maintain a ledger system that existing financial infrastructure already handles quite efficiently. The fundamental problem is this. When you strip away the hype and the jargon, most of these businesses are either speculating on asset prices or providing infrastructure for other people to speculate. That's not a business model I understand or trust. Charlie Munger used to tell me, and he was right about this, that when someone has to explain why their business is revolutionary using terms you don't understand, that's usually a bad sign. Not always, but usually I can explain Coca-Cola's business to a 10-year-old. They make beverages people like. They sell them for more than it costs to make them. They return excess cash to shareholders. Simple. Try explaining cryptocurrency mining or decentralized finance protocols to a 10-year-old. Better yet, try explaining to them why it's better than what we already have. Look, I'm not saying blockchain can't find useful applications. Maybe it will. Maybe there's a place for it in supply chain management or record keeping or something else I haven't thought of. But that's different from investing in it at these prices, in this environment with these valuations. The sector's recent performance data shows something revealing. When you analyze the correlation between cryptocurrency prices and the stock prices of related companies, they move almost in lockstep. That tells you something important. The companies aren't being valued on their fundamentals. They're being valued on the asset prices they're associated with. That's dangerous, very dangerous. When Bitcoin goes up, everything cryptocurrency related goes up. When it goes down, everything goes down together. There's no diversification there. There's no real business analysis happening. It's just momentum trading with extra steps. I've been investing long enough to recognize a pattern when I see one. And this pattern, the one where new technology creates excitement, which creates investment, which creates higher prices, which creates more excitement. This pattern always ends the same way. Most of the companies disappear. A few survive and become successful. And the investors who bought at the peak lose most of their money. That's what happened with the railroads in the 1800s. That's what happened with automobiles in the early 1900s. That's what happened with radio, television, and the internet. The technology was real. The revolution was real. But most of the companies and most of the investors still lost money. Why am I telling you this? Because I want you to understand something fundamental. When you invest in businesses tied to speculative asset prices rather than productive operations, you're not investing. You're gambling on crowd psychology. And that's a game I've never been good at. So cryptocurrency and blockchain companies, I'm staying far away. Not at these prices. Not with these business models. Not with my money. Now let me move to the second sector. And this one's going to make some people angry. I'm talking about artificial intelligence companies. Specifically, the ones that are trading at valuations that assume they've already won the future. Wait, before you write me off as some old man who doesn't understand technology, let me tell you something. I'm not saying artificial intelligence isn't real or important. It clearly is. I'm not saying it won't change the world. It probably will. What I'm saying is that the gap between revolutionary technology and good investment returns is often wider than people think. You know what else was revolutionary? The internet, the automobile, the airplane, radio, television. And in every single case, most of the companies in those spaces failed, and most of the investors lost money, even though the technology itself transformed society. Here's what I'm seeing in the AI sector right now. Companies with minimal revenue, no profits, and business models that might work someday are trading at market capitalizations in the tens of billions of dollars. In some cases, hundreds of billions. Recent financial filings show several prominent AI companies burning through hundreds of millions of dollars per quarter while generating a fraction of that in revenue. They're not building toward profitability in the next year or two. They're building toward potential profitability in some undefined future, assuming everything goes perfectly. That's not investing. That's hoping. Let me explain how I think about valuation, because this is critical. When I look at a business, I ask myself what I think it'll earn over its lifetime. Then I discount those earnings back to today's dollars. That tells me what the business is worth right now. But with these AI companies, I can't do that calculation. I don't know what they'll earn. I don't even know if they'll earn anything. The whole investment thesis is based on the idea that they'll figure out a business model later, after they've captured market share or developed better technology or found customers willing to pay. Maybe they will. But I'm not willing to bet billions of dollars on maybe. Look at what's happening with valuations. There are AI software companies trading at 50, 70, even 100 times their annual revenue. Not earnings revenue. And that revenue often comes from pilot programs and proof of concept deals, not sustainable long-term contracts. Compare that to the businesses I own. Coca-Cola trades at about 5 times revenue. Apple, for all its success, trades at about 8 times revenue. These are companies with proven business models, massive cash flows, and decades of profitability. But an AI startup with $10 million in revenue and $50 million in losses, that's worth $1 billion somehow. The math doesn't work. Now, the bulls will tell you I'm missing the growth potential. They'll say these companies are growing revenue at 200% or 300% per year. They'll show me projections of massive future markets. And you know what? They might be right about the growth. They might even be right about the market size. But here's what they're not telling you. Growing revenue is easy when you're pricing below cost to gain market share. The question is whether you can ever price above cost and still keep those customers. The question is whether the market will support enough profitable companies to justify all these valuations. Because here's the thing about revolutionary technology. It tends to create a few big winners and a lot of losers. The internet created Google, Amazon, and Facebook, but it destroyed hundreds of billions of dollars of investment in companies that didn't make it. Which ones will be the winners in AI? I don't know. Maybe you do, but I doubt it. And if I don't know, I'm certainly not going to pay premium prices betting that I can pick the right ones. There's another problem with this sector that really concerns me. The barriers to entry keep falling. When AI models can be replicated, when the basic technology is becoming commoditized, when even individual developers can now build sophisticated AI applications, what exactly is the moat? I've always looked for businesses with strong competitive advantages, things that are hard to replicate. Coca-Cola has a brand that took more than a century to build. Burlington Northern Santa Fe owns rail lines that can't be duplicated. Geico has a cost structure that's hard to beat. But what's the moat for most AI companies? First mover advantage. That disappears fast in technology. Better algorithms. Those get copied or surpassed. More data. Maybe. But data is getting cheaper and more available every day. I'm seeing a lot of companies in this space that are essentially service businesses dressed up as technology platforms. They're taking existing AI models, adding a layer of customization, and selling them to enterprises. That's a consulting business, not a technology business. And consulting businesses don't trade at 50 times revenue. Recent market analysis shows that the aggregate market cap of publicly traded AI companies is approaching $1 trillion. That's $1 trillion in market value for a sector where the total revenue is measured in the low billions and the total profit is, well, there isn't much total profit. That means the market is pricing in decades of perfect execution, massive margin expansion, and no competition. In my 70 years of investing, I've learned that decades of perfect execution basically never happens. Let me tell you about something I've watched for a long time. The hype cycle. It goes like this. New technology emerges. Early adopters get excited. Media coverage intensifies. Investors pile in. Valuations soar. Then reality sets in. The tech not as quickly or easily as promised. Revenue growth slows. Investors panic. Valuations crash. We saw it with social media. We saw it with cloud computing. We saw it with 3D printing and virtual reality and blockchain and a dozen other technologies that were supposed to change everything immediately. And we're seeing it now with AI. Does that mean AI isn't important? Does it mean AI companies will all fail? No. Does it mean you should invest in them at current prices? Also no. Here's what really troubles me about this sector. The disconnect between the stock market and the real economy. I talk to business owners all the time. Real businesses, not startups. Manufacturing companies, retail chains, insurance firms, transportation companies. And you know what they tell me about AI? They're experimenting with it. They're running pilots. They're seeing some efficiency gains, but they're not seeing the revolutionary transformation that would justify these valuations. They're seeing incremental improvements, not wholesale disruption. And the AI companies selling to them are fighting tooth and nail for contracts, often at prices that barely cover costs. That tells me something. The value is accruing to the customers using AI to improve their operations, not to the companies selling AI as a standalone product. That's great for the economy, but it's terrible for AI company shareholders. Think about it this way. When personal computers became ubiquitous, did the PC manufacturers make all the money? No. Companies like Dell and HP had thin margins and brutal competition. The companies that made money were the ones using PCs to improve their businesses, retailers with better inventory systems, banks with better record keeping, manufacturers with better design tools. The same pattern is likely to play out with AI. The real winners will be companies that use AI to do their existing business better, not the companies trying to sell AI as their entire business. Now, there are exceptions. Companies building truly essential infrastructure, companies with real network effects, companies with proprietary data or unique technology. Those might justify premium valuations. But for every one of those, there are 10 companies with generic technology, no clear moat, and valuations based on PowerPoint presentations about total addressable markets. I learned something a long time ago. When everyone knows about an opportunity, it's probably too late to make exceptional returns. When the taxi driver is giving you stock tips, it's time to sell, not buy. And right now, everyone knows about AI. It's on magazine covers. It's in television commercials. It's the answer to every interview question about the future. That doesn't mean it's wrong, but it does mean the easy money has probably been made. Here's another way to think about it. Let's say I'm right that AI is transformative. Let's say it does change everything. Who benefits? Well, companies with lots of data benefit. Companies with existing customer relationships benefit. Companies with distribution channels benefit. Large established businesses that can deploy AI across massive operations benefit. In other words, the companies I already own benefit. Berkshire's insurance operations can use AI for underwriting. Our utilities can use it for grid management. Our retailers can use it for inventory optimization. But I get that benefit without paying AI company valuations. I'm buying profitable businesses at reasonable prices that will use AI as a tool, not buying AI companies at unreasonable prices hoping they figure out how to be profitable. That's the difference between investing and speculating. I'm buying businesses I understand at prices I can justify. The AI speculators are buying futures they hope will materialize at prices that only make sense if everything goes perfectly. In my experience, things rarely go perfectly. Financial data from recent quarters shows something else that concerns me. Many AI companies are seeing their customer acquisition costs rise while their customer lifetime values remain uncertain. They're spending more and more to add each new customer, but they don't yet know if those customers will stick around and prove profitable. That's backwards. In a healthy business, customer acquisition costs should be falling as your brand builds and your distribution improves. Customer lifetime values should be rising as you learn what your customers really need and how to serve them better. When I see the opposite pattern, I get nervous. It suggests the market is getting saturated or the value proposition isn't as strong as the pitch deck claims. Look, I understand why people are excited about AI. I really do. The demonstrations are impressive. The potential applications are vast. The technology is legitimately advancing. But impressive demonstrations and good investments are not the same thing. Vast potential and actual profits are not the same thing. Advancing technology and shareholder returns are not the same thing. I've seen too many technology revolutions to confuse the two anymore. The technology can be world-changing while the investments are wealth-destroying. Both things can be true simultaneously. So when I look at AI companies trading at valuations that assume they'll dominate the global economy, I see risk. Tremendous risk. Risk that the technology doesn't progress as fast as hoped. Risk that competition intensifies. Risk that margins never materialize. Risk that we're in the excitement phase of the hype cycle, not the rational valuation phase. And I don't get paid enough to take those risks. Not when I can find profitable businesses with strong competitive positions trading at reasonable valuations. That's my second sector to avoid. AI companies at current prices. Maybe I'm wrong. Maybe these valuations will prove justified. But I'd rather miss an opportunity than lose money chasing a story I don't fully understand at prices I can't justify. Now let me talk about the third sector. And this one might surprise you because it's been popular for a long time. I'm talking about unprofitable software as a service companies. The ones trading on revenue multiples instead of earnings multiples because, well, there are no earnings. You know, there was a time when software was one of the most beautiful businesses you could own. High margins, recurring revenue, low capital requirements. I've admired companies like Microsoft and Oracle for decades. They print cash. But somewhere along the way, something changed. The software industry decided that profitability was optional, that growth was all that mattered, that you could lose money on every customer and make it up in volume somehow. And the market went along with it for a while. Here's what I'm seeing now. Software companies with hundreds of millions in revenue, and yet they're losing money. Not investing heavily for future growth in the way Amazon did, actually losing money on their core operations because their cost to acquire and serve customers exceeds what those customers pay. Recent company filings show dozens of publicly traded software firms with margins above 70%, which should be fantastic, but operating margins of negative 30 or 40%. Think about that. They're making 70 cents of gross profit on every dollar of revenue, but somehow spending more than $1 total to run the business. Where's the money going? Sales and marketing. These companies are spending 50, 60, sometimes 80% of revenue on sales and marketing, trying to grow as fast as possible. They're in a land grab, trying to capture market share before someone else does. But here's my question. What happens when the land grab ends? What happens when they have to actually run profitable businesses instead of just growing unprofitably? I don't know the answer. And when I don't know the answer to a fundamental question like that, I don't invest. Let me tell you what concerns me most about this sector. The business model assumes that once you acquire a customer, they'll stay forever and eventually you'll make back your acquisition cost plus a profit. That's called customer lifetime value exceeding customer acquisition cost. But the data is starting to show something different. Analysis of industry trends reveals that customer churn rates in software are rising. Companies are switching providers more frequently. The switching costs that everyone assumed would keep customers locked in aren't as strong as hoped. So you spend $50,000 to acquire a customer who pays you $10,000 a year, and you assume they'll stay for 7 or 8 years so you can make your money back and then some. But what if they leave after 3 years or 2? Suddenly, the math doesn't work at all. And that's exactly what I'm seeing in the data. Companies are extending their payback periods. They're revising their lifetime value assumptions. They're quietly acknowledging that the unit economics aren't working out as planned. But the stock prices, they're still based on the old assumptions, the optimistic assumptions, the assumptions that everything will work out perfectly. I've learned over the years that when a business model requires perfect execution over many years, you should be skeptical. When it requires customers to behave exactly as hoped, you should be even more skeptical. And when it requires both, you should run. Here's another problem with this sector: the competition. When I look at most software categories, I see dozens of companies doing essentially the same thing: customer relationship management, human resources management, marketing automation, project management. They're all raising venture capital. They're all hiring expensive sales teams. They're all spending heavily on marketing. They're all fighting for the same customers, and they're all unprofitable. So who wins? Maybe 1 or 2 in each category achieve enough scale to become profitable. But the rest, they either disappear or get acquired for less than investors put in. And yet the market is valuing all of them as if they'll all be winners, as if there's room for 15 profitable companies in every software category. There isn't. I remember Charlie used to say that most businesses are worth less than 0 to passive investors. They consume capital, never generate enough return on that capital, and would be better off not existing. He was talking about competitive industries with no clear winners. That's what I see in much of the software sector now. Lots of companies burning cash to compete with each other, with no clear path to sustainable profitability, valued by a market that seems to believe growth solves everything. It doesn't. Growth without profitability is just a path to a larger loss. The current market data shows the median software company trading at about 10 times revenue. 10 times. For context, that means if they could somehow turn all their revenue into profit, which is impossible, it would take 10 years just to earn back your initial investment. And most of these companies aren't turning revenue into profit. They're turning revenue into losses. Now, I'm not saying all software companies are bad investments. I'm saying unprofitable ones at high valuations are. There's a big difference. The great software companies, Microsoft, Adobe, Salesforce, back when it matured, they have real moats, network effects, switching costs, proprietary technology, and most importantly, they're profitable. They generate cash. They can fund their own growth and return money to shareholders. But these dozens of unprofitable software companies, they don't have those advantages. They have hopeful projections and persuasive management teams and business plans that look great in presentations but haven't translated to actual profits. So that's sector 3, unprofitable software companies trading at revenue multiples that only make sense if you assume they'll eventually figure out profitability while maintaining growth and keeping competition at bay. Too many ifs for me. Now, the 4th sector I'm avoiding is going to resonate with anyone who's been watching the office market: commercial real estate, specifically office properties and the companies that own them. This one's different from the others because it's not overvalued in the traditional sense. In fact, prices have already come down significantly. But here's the thing: I think they're going to come down a lot more. And I don't buy falling knives. Let me explain what's happening. The pandemic changed work patterns in ways that aren't reversing. Companies discovered that remote work actually works for many roles. Employees discovered they prefer it. And now, even as companies try to bring people back to the office, the reality is that office utilization is permanently lower than it was before. Recent industry surveys show office occupancy rates in major cities running at 60 to 70% of pre-pandemic levels. Some cities are even lower. And this isn't temporary. It's been years now. This is the new normal. But here's the problem. The office buildings were financed assuming 95% occupancy. The rents were set assuming high demand. The valuations were based on cash flows that no longer exist. So what happens? Vacancy rises, rents fall. Cash flow declines, property values drop, and for leveraged real estate, which is almost all of it, that creates a very dangerous situation. Let me walk through the math because this is important. Let's say you own an office building worth $100 million with a $70 million mortgage. Your equity is $30 million. Now occupancy falls and rental income drops 25%. Suddenly the building is only worth $75 million. Your equity went from 30 million to 5 million. You lost 83% of your investment, even though the building only lost 25% of its value. That's the power of leverage. It magnifies returns on the way up, and it magnifies losses on the way down. And here's what really worries me. We haven't seen the full impact yet. Many of these buildings have long-term leases that are still in effect. Tenants signed 10-year leases back in 2015 or 2017 when everyone assumed office work was permanent. But those leases are rolling over now. And when they do, companies are either downsizing their space, negotiating much lower rents, or moving to newer buildings with better amenities. The older Class B and Class C office buildings are getting crushed. Financial data from major real estate investment trusts shows something alarming. Several large office-focused REITs are trading at 40 to 60% below their asset values from just a few years ago. The market is already pricing in significant distress, but I think it's going to get worse, much worse. Here's why. The refinancing wave hasn't hit yet. Billions of dollars in commercial real estate debt was financed at 3 or 4% interest rates back when money was cheap. Those loans are coming due over the next 2 to 3 years, and they're going to need to be refinanced at 7 or 8%. That doubles the interest cost. For properties that are already struggling with lower occupancy and falling rents, doubling the interest expense is catastrophic. What happens when you can't make your loan payments? The lender takes the property. What happens when lenders take hundreds of office properties? They sell them, often at steep discounts, to get them off their books. What happens when hundreds of office properties hit the market at once? Prices collapse further. This is how real estate cycles work. Slowly at first, then very quickly. And I see all the warning signs that we're in the early stages of a real collapse in office real estate values. Now, you might think this is a buying opportunity. Properties are down. Why not buy? Here's why. I don't see a catalyst for improvement. I see a structural change in how people work that's permanent. Unlike the housing crisis in 2008, where you knew people still needed places to live and housing would eventually recover, I'm not sure office space is coming back. At least not at the levels needed to support current valuations. Some cities will adapt better than others. Some buildings will find new uses. Some will be converted to residential or torn down. But that takes years and enormous capital. In the meantime, investors are stuck with declining cash flows and underwater loans. I've looked at buying distressed real estate before. Sometimes it makes sense. But this is different. This isn't a temporary downturn. This is a fundamental shift in demand. And I don't invest in assets where demand is permanently impaired. The numbers tell the story. Office vacancy rates in cities like San Francisco are approaching 30%. That's not a recession blip. That's a structural problem. And it's spreading to other major cities. Here's what I tell people who ask me about commercial real estate investing right now. If you can't afford to lose the money, don't invest it. If you're using leverage, be very careful. If you're counting on things returning to 2019 norms, you're going to be disappointed. I'm staying away, far away. The risk-reward doesn't make sense. The downside is massive. The upside is uncertain. And there are too many better places to put money. That's Sector 4, commercial real estate, particularly office properties. The crisis is already here, but I think it's going to get much worse before it gets better. Now, let me talk about the fifth and final sector, and this one encompasses a broad category. I'm talking about highly speculative, cash-burning companies in emerging sectors, biotech companies with no approved drugs, space companies with no revenue, clean energy companies with unproven technology. Basically, anything where the investment thesis is we'll figure out how to make money eventually. These companies share common characteristics. They have exciting stories, revolutionary potential, smart scientists or engineers, impressive-sounding technology, and they're burning through cash at an alarming rate with no clear path to profitability. The market loves these stocks when sentiment is positive and risk appetite is high. But when conditions tighten, when investors demand actual profits instead of potential profits, these are the first stocks to get crushed. And I think we're heading into a period where investors are going to care a lot more about actual profits. Let me explain why. For the last 15 years, money has been cheap. Interest rates were at zero. Investors had to reach for yield and growth wherever they could find it. That created a perfect environment for speculative companies. They could raise endless amounts of capital because investors had nowhere else to put their money. But that's changing. Interest rates are higher now. Treasuries are paying real yields again. The opportunity cost of tying up capital in speculative ventures is much higher than it was. What does that mean? It means these companies are going to have a much harder time raising capital. And if they can't raise capital, they can't fund their burn rate. And if they can't fund their burn rate, they either die or get sold for pennies on the dollar. Recent market trends show this is already happening. Several high-profile biotech companies have had to shut down or merge because they couldn't raise another round of funding. Space companies are scaling back plans. Clean energy ventures are missing milestones and seeing valuations collapse. This isn't a surprise. This is what happens when the money spigot turns off. The projects that don't generate cash are the first to struggle. Now, some of these companies will succeed. Some will develop breakthrough products. Some will solve important problems. But most won't. That's just the reality of high-risk ventures. Most fail. A few succeed spectacularly. And as an investor, you can't know which is which ahead of time. So how do I think about this? Simple. I don't invest in businesses where the probability of success is very low, even if the potential payoff is very high. That's gambling, not investing. Venture capitalists do this for a living. They invest in 10 companies expecting 9 to fail and 1 to return enough to cover all the losses. That's their business model. But it's not mine. I want to invest in businesses where success is highly probable and the returns are good enough to justify the time and capital. Businesses that are already working, already profitable, already proven. These speculative sector companies are the opposite. Success is possible but improbable, and the capital requirements to get there are enormous and uncertain. Here's what the data shows. Analysis of biotech companies that went public in the last decade reveals that more than half are trading below their IPO price. Many are down 70, 80, 90%. A few are up 500 or 1,000%. If you picked randomly, you'd have lost money overall. Only by being exceptionally good at picking the winners or exceptionally lucky could you have made good returns. And I don't rely on being lucky. The same pattern holds in other speculative sectors. Most companies fail. A few succeed. The average return is poor. Only the winners talk about their gains. The losers quietly disappear. So when I see people pouring money into these sectors, chasing the next big breakthrough, I think about all the breakthroughs that never materialized, all the revolutionary technologies that stayed in the lab, all the game-changing products that nobody wanted to buy. Innovation is hard. Commercializing innovation is even harder. Building a profitable business around innovation is hardest of all. And betting your savings on companies trying to do all three simultaneously is, in my opinion, a mistake. I'd rather buy Coca-Cola and wait. I'd rather buy Burlington Northern and collect dividends. I'd rather buy boring, profitable businesses that do mundane things really well than exciting, unprofitable businesses that might do revolutionary things someday. That might make me sound old-fashioned. That's fine. I've been old-fashioned for 70 years and it's worked out pretty well. So that's the fifth sector, speculative, cash-burning companies in emerging industries. Maybe some will win big. But as a category, I think investors are going to lose a lot of money in these names over the next few years as capital gets scarce and patience runs out. Look, I know some of you are sitting there thinking I'm too conservative, that I'm missing opportunities, that the world has changed and the old rules don't apply. Maybe. But I've heard that before. I heard it in the 60s with the go stocks. I heard it in the 80s with junk bonds. I heard it in the 90s with internet stocks. I heard it in the 2000s with housing. And you know what? The old rules always apply eventually. Profitable businesses outperform unprofitable ones. Reasonable valuations beat excessive ones. Patience wins over speculation. These aren't old-fashioned ideas. They're timeless principles. So when I look at these 5 sectors, cryptocurrency and blockchain companies, overvalued AI firms, unprofitable software businesses, distressed commercial real estate, and speculative emerging sector companies, I see the same mistakes being repeated. Different industries, different stories, same outcome. People buying things they don't understand at prices they can't justify, hoping someone else will pay more. That's not investing, that's hoping. And hope is not a strategy. I'm going to keep doing what I've always done. Buy businesses I understand. Pay reasonable prices. Wait patiently. Let compounding do its work. It's not exciting. It won't make headlines. But it works. It's worked for 70 years. And I believe it'll keep working for the next 70. So if you own stocks in these 5 sectors, ask yourself honestly, do you understand the business? Can you justify the valuation? Are you comfortable holding if the price drops 50% tomorrow? Because if you can't answer yes to all 3, you might want to reconsider. Your financial future is too important to gamble with. And that's what I think these 5 sectors represent right now. Gambles dressed up as investments, I'm staying away. And I think you should too.